On today's episode of the AI Investor Podcast from 24/7 Wall Street, we are going to talk about earnings from Nvidia, Snowflake, the AI boom in the Middle East, robots, yes, robots, all that and more is next. Welcome to the AI Investor Podcast from 24/7 Wall Street. I'm your host, Austin Smith, joined as ever by Eric Bleeker. Now, our intrepid listeners will note I am not your usual host, David Hanson. I'm Austin Smith, and I'll be stepping in for David and filling the large shoes that he has left here. That's a tall order, but frankly, no one is really interested about the role that I play as host, Eric. They want to hear from you all about investments and AI.
Oh, don't sell yourself short, Austin. It is with sad news that we do have to reveal David Hanson is dead. To this show, he has taken another job. We wish David well. But yes, going forward, Austin has been lifelong kind of someone that I talk with investing about. We both own our business, Flywheel Publishing, together. He is someone who loves to kind of be in the ebbs and flows of investing from a day-to-day basis. And we have probably, on the conservative end, I would say filmed about 2,000 hours of video talking about the stock market together. Don't search out old ones. We've gotten better, I promise. But it should be great. And I'm happy to have you on, Austin. For listeners of the show, if you've noticed, normally we try and record at a 2-week cadence. We are getting a little stretched out. We've been stretched out the week before. Well, as I noted in the prior podcast, our business has started a relationship with Motley Fool, which is demanding more of our time. But also, we did need to replace David. So I appreciate everyone bearing with us. We plan to continue kind of giving you the best news every single week. And hopefully in this next couple of weeks, we can get back to our normal schedule. So Austin, let's kick off. You had previewed what we're looking at the show today. It's going to be exciting. We're going to do a preview of some of the biggest themes that we're anticipating. But I do think a lot has happened in the past month. Let's start by reviewing earnings. What would you like to talk about first?
I actually wanted to talk a little bit about last episode to give you a little bit of a call out here, because then you discussed analogies to COVID and the crash and the uncertainty and the need at the time for people to see through the investing cloud, so to speak. And here we are 1 month later, and everybody's caught up with you. The NASDAQ is up 10%. Earnings are back in vogue. We're seeing stocks up 5, 6, 7% after hours on strong beats, or strong forecasting and guidance. So the exact thing you talked about a month ago, when we look back just a few weeks, has already started to play out. The market is now starting to look through some of those clouds. And I think there's no better example than the reaction we're seeing out of the Super Bowl of earnings, Nvidia. So let's talk about what happened. As of this filming, the stock's up about 5% or so. I mean, this was an absolutely monster quarter, right? $44 billion in first quarter revenue. And I found a stat that blew me away. In the last 5 years, that is up 20x from $2.2 billion in 2020. I mean, that just shows how far we've come in the sort of, growth curve we're riding here. But Eric, what did you see in Nvidia's earnings?
Yeah, it's a whole new company, as you mentioned, and kind of a different... It was a different setup for earnings than we've seen from Nvidia in a long time, because generally headed into earnings, we see expectations rising and rising and rising for Nvidia. This time was completely different. In fact, if you go back 2 months ago, the Wall Street's EPS that they were looking for was 93 cents per share. By the time we got to earnings, that had dropped all the way down to 75 cents. So instead of kind of these rising expectations for the best quarter ever, it was seeing if Nvidia could kind of get through some uncertainty here. And they did deliver very well. As you had noted, we're looking at $4 billion on the top line. That's a beat. They reported 81 cents in earnings versus Wall Street expectations of 75 cents. And the kind of $2.5 billion question this prior quarter, I believe, is what they quantified at. They had to stop selling chips to China. They have special export compliant H20 chips that are created specifically for the Chinese market. Essentially, without warning, they were told that they needed to stop selling them to China. They took an expense for that. If it wasn't for that expense, they would have recorded 96 cents in earnings, which is above that 93-cent target they were previously at a couple months ago. So why does Wall Street like these earnings so much? They were a little light on guidance, I should note. Well, a lot of it is, if you back out China, because they gave figures. I believe it was $8 billion they would have seen in the coming quarter for China. Ex-China, the revenue growth is just tremendous. So we hosted a live blog on this on 24/7 Wall Street. Little pitch, if you are an investor out there, we are now doing live blogs for just about every major company's earnings. So we're going to have, for example, Broadcom next week. I am going to be hosting a live blog. If you come to our website, you're going to be able to see that. You're going to get immediate analysis on, those major companies in your portfolio. But we were hosting this live blog. I kept saying, this is the highest nuance quarter ever. And, you couldn't just look at the numbers that Wall Street was expecting because they are looking at the bigger picture. And Austin, the bigger picture is this, that every single channel check right now, and this is a key theme. If you've been listening to the show, you'll know this. Every single channel check says the growth of inferencing is absolutely exploding. So how will you see this often, presented in analyst research reports? It's the number of tokens being used. Users are coming to AI and using it at a massive level. And also these newer models that are the massive breakthrough are using inferencing at historic levels. So, we're seeing validation to the concept that we had talked about in the show, that these new reasoning models that came out just at the tail end of last year are a true breakthrough. We're starting to see that out in the wild, and that's driving a lot of demand for Nvidia. So we've got that. Second, Wall Street's pretty pleased how good they can do ex-China, because as we're going to get to later in the show, Austin, we're going to talk about China a lot in the show today, but there's been some other deals announced, specifically some massive deals in the Middle East, and those are going to start seeing volume in 2026. So if Nvidia can weather this storm of essentially being cut out of China, they're going to have some powerful new catalysts in the next year ahead. Finally, Austin, I do want to say, we've talked a lot about Blackwell, which is Nvidia's new chips. And it's one of the most powerful launches ever. It's probably going to be the most profitable launch for a single product ever, surpassing even iPhone launches, which is an incredible thing to say. And what happened was they were having a lot of problems being able to scale these up. The server racks, because they sell these large systems of Blackwell chips that cost millions of dollars, they were having problems with liquid cooling. It sounds like there's been breakthroughs to be able to solve the issues with that, start building them at scale. That's great news for Nvidia. It's also great news for portfolio component Vertiv, which we have seen bounce significantly off the bottom. And Austin, as you had alluded to, when I was detailing those stocks I was buying at the bottom, Vertiv was one of those. And I think we are already at about a 50% bounce since the bomb. So, Austin, that was a lot to take in. I don't know if you have any follow-ups on that, but that's what I'm seeing from NVIDIA's earnings.
I mean, it's absolutely remarkable. It feels like, the pendulum swings between we're so cooked, we're so back, and this feels like it's a we're so back moment. And yeah, to sort of show our listeners that this is truly a tide that sort of supersedes any individual product or market and how strong that is. NVIDIA is recording this sort of performance after a $4.5 billion charge on their limitation of selling H20s. That just goes to show how strong the demand is out there. I mean, how many companies do you know put up a performance like this, still rising after earnings while taking a $4.5 billion charge? I mean, that charge is larger than the revenue for some major number of S&P 500 companies. I mean, that just goes to show the size of this megatrend, and that's why you've put your money on the line to help yourself and investors position themselves to profit from this trend. Let's move on from the juggernaut that is NVIDIA. Let's talk a little bit about Synopsys and Cadence. There's some interesting news here, particularly on Wednesday, also portfolio stocks. What did you see?
Yeah, a couple stocks that are in the portfolio. I know the portfolio has been going for a long time now, so I'll forgive anyone if they can't remember the names in the electronic design automation space. But basically, Synopsys, they build a software that allows you to make chips. And we've loved this competitive position. Yesterday, which was Wednesday, we're recording this on Thursday, May 29th, they were about to release earnings, and 30 minutes before, their stock goes into an absolute free fall. We were doing a live blog on this as well, and you're looking, going, what is happening? Why is the stock? Did earnings leak? There's nothing of that sort. What did leak was a report from the Financial Times that the Trump administration is going to restrict EDA software sales from China. Now, the company itself said that they hadn't received this notification from China, so it's not going to be baked into the results per se, but they are going to continue accelerating in the second half, despite already forecasting significant declines to China. I should note that China is less than 10% of their business last quarter, so they've already been kind of pivoting away from them. So again, the broader theme we're going to touch on more as this show goes is this just continues to show that we are rapidly approaching a situation where we have a Chinese tech ecosystem and a Western tech ecosystem, mostly led by America. Because you're going to have companies that get really hurt by this situation. There will also be some opportunities, which we'll discuss a little bit more. But for Synopsys, they're bouncing back a little bit today. It's a name I had added at the bottom. If they continue to get sold off on this, I will continue adding them, as I know they were already decreasing the reliance on China as is. And they're showing a lot of strength, right? You know, these companies, despite weakening sales from China, despite weakening sales to most semiconductor markets, AI has been so powerful that basically the trend alone was causing still significant acceleration in the second half of the year for them. So again, I just wanted to preview this because it's showing another dimension that right now, if you are investing in a lot of this AI space, it's increasingly going to become something akin to a new Cold War. And we can't afford to just invest on the companies themselves. We are going to need to look at this geopolitical situation because it's going to increasingly drive which stocks are winners and which stocks are losers in the trend.
Yeah, Eric, that's a really wonderful point. You know, a book that you actually recommended to me and I would recommend to our listeners as well is Chip War by Chris Miller, which goes back and discusses actually some of those geopolitical investments that really drove the technology sector forward and really made the US so cutting edge, particularly driven by the space race. And understanding the geopolitical dynamic at that time, you know, if somebody was following the money, so to speak, and following the investments that were coming as a result of the Cold War and looking at companies like Texas Instruments at the time or Intel early on, they would have been able to profit handsomely. So there's this new entering dimension geopolitically. It's anyone's guess what will happen. The story changes every day, but if you watch it consistently enough and you're paying attention, you can see where the tides are going and position yourselves to profit.
Yep. We'll have more to talk about on this front as well, I should know.
As soon as we see updates, we will share them with our investors and listeners here. Let's look at one of my favorite companies, which is Snowflake. Looks like they had fantastic earnings. We've also seen some acquisitions out of Snowflake. What was a company that they bought recently in late 24? They announced an acquisition. Tell me what's going on with Snowflake. Look at the numbers.
Yeah, no, I mean, Snowflake, the big picture is at the tail end of 2024 and early into 2025, we had said we want to increasingly shift our focus into software names. So we've had companies like Unity, Snowflake, GitLab, Cloudflare. GitLab's done the most poorly out of this group, but the other three have generally done fair to very well. We're talking, 15% to 30% since, we had purchased them. Snowflake recently reported, as you know, they had a beat and raise. So I think what we want to watch in the software category is we stretch into the second half of 2025. Companies that have core products that are performing well, and they're going to be able to bolt on AI features are the companies that we want to be adding to this portfolio. Because as we've previewed before, if you look at Palantir, what they did was they essentially went from 20% growth, they accelerated that to 35% growth, and they have great narratives around their AI leadership. And that turned them into a generational opportunity for investors. Snowflake, right now, their product revenue is kind of growing in that mid-20s range. If they can continue to add on features that are very attractive in the AI space, if they could grow that into the 30s, I think we see some version of a repeat where even at expensive levels, they get that re-rating. So the good news is Snowflake next week, they're going to do their summit, which they're almost certainly going to announce a ton of new AI features. We'll probably dive into some specifics after they do that. But I want to talk about this profile and positioning that we're looking as we head into the second half of the year and the opportunities that we're seeing in some of these software names. Cloudflare is extremely expensive stock. As I noted when we first recommend them, they might have the strongest tailwind at their back of any stock in the software space. And I don't think that being as expensive as they are precludes opportunities with the kind of growth that they might see in the years ahead. And again, it's not a company that's decelerating in growth. I think all of these companies are about to see an inflection point where they hit a new period of expansion. So exciting earnings from Snowflake. It's doing exactly what we wanted, right? Keep seeing that product acceleration uptick, and if we can see that growing from quarter to quarter to quarter, it's almost certainly going to be a winner throughout not this year but next year as well.
If our investors and listeners want an analogy to contextualize what it is you're talking about, I'm glad you mentioned Palantir there, because that's actually a company that you called in early 24 as one of the winners of the AI boom, and it then went on to become one of the best performing stocks in the S&P 500 this year, and largely one of the precursors to us launching this portfolio. So that's the sort of, the power of accelerating revenue growth. If you want to understand what that can do to a company's share price, look no further than Palantir.
Yeah, unfortunately, one that's not in the portfolio. Thanks for bringing that up, Austin.
Well, to our readers on 24/7 Wall Street who access the free report that you gave, they are thanking you from their private jets.
It's all right. You can't win them all.
Let's look at the market. So we've talked about a couple companies here, some of the big AI winners. I want to take a step back and look at the market. And here's a headline I didn't expect 4 weeks ago. The NASDAQ is now up year to date. I believe the S&P 500 is as well. And one of the exercises that I think is important to sort of contextualize how crazy this is, if you were to outline all of the headlines that investors had seen since January 1st and not tell anybody what the end results were and just said, what do you think will happen to the market? We all would have looked at those headlines and said, down 20%, down 30%, cut in half, right? But yeah, here we are in just 4 short weeks. The markets have rebounded. They've prevailed. What's going on? We know it's still early in the year. We don't want any premature victory laps, but this is a remarkable rebound.
Yeah, it's interesting you bring up that exercise, which is a great exercise. I love doing it because it keeps you humble. But number two, if you look at the earnings from these technology companies, you'd also say there's no impact from the geopolitical headlines, right? You pull up a CNBC or the front page of a newspaper and everything looks so grisly, but the performance and the ability of the companies in our broader portfolio to continue delivering has been nothing short of exceptional. So, I think as you did a good job tooting my horn earlier, I won't do it again, but we had said that we had believed when basically the market was at the nadir, we did believe that we were past the worst of it. For varying reasons I've outlined in previous episodes, we have had some restrictions on stocks we can actively buy, but I have been talking about stocks I've been personally adding in my own portfolio. Now, I will say I haven't bought anything in the past few weeks because of what you said. We are now back to a valuation that was similar to where we began the year. I was a little nervous about the market writ large at the beginning of the year. We are on the upper end of kind of valuation levels historically. So I think, the highlight is the buy the dip opportunity is over, right? Getting some of the screaming deals that you would have been able to see, Nvidia trading in the mid 140s today, knowing that it was down to $90 a share. That was a screaming deal in retrospect. But all the same, I still believe that there's a lot of opportunities, a lot of growth areas in the market. And just because the market's rebounded doesn't mean that we're going to have a lot of exciting things to talk about, a lot of exciting trends. AI continues to grow at phenomenal levels. So did people miss buying the dip if you sat on your hands? Well, yes. Is there a potential in any given week for another 5% drop with one announcement from the Trump administration? That's not going away anytime soon. And the third thing is, are we still excited about the overarching trend of artificial intelligence and the subtrends? Of course. Not a lot has changed to lessen our enthusiasm since we launched this podcast. In fact, I would say it's accelerated.
Wonderful. Well, yeah, appreciate that context. And look, we have to stay humble here. This is one of the challenges of investing. One of the investors that you and I had both, worked with and admired for many years, Dave Gardner, right, said, stocks go down faster than they go up, and sometimes it can be hard to nail those dips. But that's part of the joy and challenge here.
Although another dip where they bounce back just as fast. I think everyone's just getting comfortable with V recoveries. It won't always be this way, but it is another V.
It is a reminder that markets keep you humble, right? All of the old rules, mostly apply, we will say, but it can always look and feel a little different. It's hard to spot the bottoms there, but that's why we're out there every day providing guidance on 24/7 Wall Street about where investors can put their money today to position themselves for tomorrow.
Yep.
Eric, let's talk about something somewhat esoteric, which is diffusion rules. This is a policy approach that sort of spans two administrations. It was created in the final days of the Biden administration. The Trump administration has reversed course. What's going on here? What are diffusion rules?
Yeah, as you noted, diffusion rules. We've got a few dozen listeners for this podcast. If you want to go deep, I've got a diffusion rules podcast that has 2 listeners.
So it's just the two of us.
It's just the two of us. I won't go deep on this. Basically, we had talked about this at the beginning of the year, saying it was a kind of headwind when we're monitoring headwinds to the broader AI space. As you noted, kind of right when they're in the cusp of going out the door, the Biden administration had dropped this, and it separated the world into 3 tiers. Tier 1, I think it was only like 17 countries, was you can get our GPUs without restrictions. Tier 2 was most of the countries in the world, and it set kind of an export control board, and there was limits to how much you could buy. And tier 3 was countries like China, which was, you've got heavy controls. So a lot of people have been celebrating the removal of these diffusion rules. I've got a little bit more nuanced read on this, which is, yes, they're not going to enforce the rules that Biden announced, but instead, I think what's going on right now, which is a broader theme we're picking at, is that AI is now kind of the central geopolitical issue of our times. And what Trump's going to do is use this as a negotiating tactic. So if he's talking with Malaysia and wants a trade deal done, well, Malaysia was a country that suddenly was in that tier 2 bucket, had a lot of AI investment in the country. If you want to make a deal to get into kind of the most advantaged AI thing, is going to be part of your trade deal. So I think we've moved from something where diffusion was going to be the rules that Biden set to now it's kind of a negotiating tactic, which, Austin, I'm going to pause on that because when I sent you over the topics I want to talk about today, there is a big one in the Middle East where we're going to see this negotiation in action.
You had talked about the Middle East. Let's move to that. There's an absolute AI boom going on, right? There's Saudi Arabia has a $40 billion AI investment fund. Stargate has announced something with the UAE. The Middle East is not slowing down. They do not want to be left out of this party. What are we seeing?
Yeah, in both Saudi Arabia and UAE, they were both in that tier 2 bucket, which was deeply concerned for the countries because if AI is going to be kind of the dominating feature of their economy in the decade to come, and you're limited on chips, that's an existential crisis. So Trump used this as basically a negotiating tactic. He went to those countries and made a series of major announcements. The announcement from Saudi Arabia is $600 billion investment. Again, that's PR. You always got to go down and get into the details. But the UAE announcement is for basically, as you know, Stargate UAE with capacity targeting past 5 gigawatts. So what we're talking about is something very much on the scale of Stargate in the United States. Now, what do we look at this from, the big picture perspective? Well, one of the companies that's going to benefit the most from this is Nvidia. Nvidia's talked a lot about moving supercomputer production back to the United States within a year. A problem for Trump is you can't have the companies that play ball with your Made in America initiatives and kind of screw them over and over, for lack of a better word. You look at Apple, if Apple's playing ball and they're issuing their PR that they're making a $500 million investment in the US and they're working to move production out of China, you need a carrot and a stick, right? So in a way, this deal with the UAE kind of backfills some of the demand that Nvidia is losing from China. And the number is, starting next year, 2026, Nvidia should start seeing hundreds of thousands of chips selling to the Middle East from this deal. The second thing I'm going to talk a little bit more about at the end of this podcast as we look at major themes in the year ahead is it gets both of these countries, which they could be kind of that pivot place between the US and China, it gets them on the United States technology stack. So that's really important because in this kind of Cold War that's brewing, we might have countries more reliant on Chinese technology and American technology. And it strikes today at kind of the early innings of AI to get these major countries kind of into that Western or American camp. So I think we're going to see more and more of this where, we've talked a lot about trade wars and whether or not a country needs to be in the, camp of the United States or China. Pretty soon that's going to extend to technology where countries are going to need to choose. Are you in the camp of kind of the Western countries or are you in the camp of China? And this is going to have massive ramifications. So, this is a big deal. It's going to have big outcomes for Nvidia in the next year, but it's also a preview, I believe, of where the world is heading.
I love that point. And one of the maybe leading indicators or canary in the coal mine that I'm going to be paying attention to here to see who's winning market share in this East versus West AI tech Cold War is Alibaba. Are they securing cloud contracts from European nations or other allies? And that might be a leading indicator of Western nations maybe being more tolerant or embracing Chinese technology and Chinese platforms and Chinese cloud computing. So that's one that I'm going to be watching to see how much does that scale to ex-China and other nations and bringing in that Chinese technology inwards, and how much are they winning there?
Mm-hmm.
So, Eric, we had started this podcast all about directing investors with how to invest the money. You put your own money on the line. Let's turn to the portfolio. We've alluded to a very strong rebound in the last 4 weeks. The portfolio has reflected this. I'm seeing a lot of green in there right now. Talk to me what's going on in the portfolio. How's it doing?
Some green. Not as much green as they're like. No, it's rebounded quite a bit, as you said. Right now, as I looked this morning, I was down about 2%. The worst decision that's weighing it down was the larger investment in Amazon and Meta, which at the time we had done as kind of a hedge because those companies could benefit if some of the suppliers lost their pricing power. Unfortunately, that was before the worst Magnificent Seven sell-off we've seen in years. Without them, the portfolio would be up about 3%.
Eric, I would also note, to give you a little credit here, Meta is still up almost 17% in the last month. So this is not an issue of having the wrong thesis, but maybe just the wrong timing, which these are the markets. We can't always get it right.
Yeah. And the good news is I had bought outsized positions of those with the idea of we would reallocate, kind of shaving the positions down. When Meta's trading at the absolute bottom or Amazon's trading, I don't want to sell them to reallocate because we're at a almost a actually low level for companies of this quality. And now they're not all the way back, but they're enough you can start doing that. Austin, if I need to give this portfolio a grade, I would probably be C. Maybe we're getting up to C plus, maybe even B minus. We're just kind of in the directional range of the market. Now, in the short run, and we are still in the short run, most of these picks haven't been baked for more than a half year. No one's going to outperform the market 100% of the time. If you're investing in a mega trend, you are at the whims of basically how favorable that mega trend is. And even the largest mega trends go through periods of kind of manias and they go through periods of retraction. So on the positive side, we've called some great companies with outsized positions, like Broadcom is one of the areas I would highlight. Broadcom's had an outstanding run since we first recommended it. I should also note we're very heavy into semiconductors. Those have been generally down since we launched the portfolio. Semiconductors, the main indexes have not fully rebounded. We are in a basket that has faced some challenges. On the negative side, I would say our riskier bets haven't worked out as well. We went pretty deeply into things like optical stocks, whether it's Marvell with exposure or Coherent or Lumentum. And generally those stocks, we maybe got a little too late into this cycle. Now, are we going to sell those stocks? I haven't made that decision yet. We'll have to see. I'm trying to look at the long-term opportunities, but I do think we're going to have some opportunities in the second half of this year to kind of rebalance the portfolio for some of the larger themes that are emerging, which, it's pretty exciting because we'll have, and we'll go into a little bit more detail in a minute. We're going to have things like robotics, self-driving cars is truly exciting. Areas like agentic AI is extremely exciting. So right now, when we first started the portfolio, it was kind of data centers or nothing. And the further and further we get into AI, the more and more opportunities we have. We can balance it across other sectors. We won't be as reliant on these semiconductor plays. So I'm really excited for kind of the second half of 2025.
Yeah, you and me as well. And as you have discussed many times, we are still very much in the early innings here. I mean, if you think about investing in the internet, right, back in, let's say, the early 2000s or even the 2008, 2009, companies like Amazon and Netflix that have gone on to have absolutely life-changing wealth experienced a lot of volatility. Netflix had their Quickster rollout, put them down around $9 a share. Today, they're almost up at 1,200. Amazon at one point went down below $3 a share, and we know what's happened since then. So when you're looking at megatrends this big, you do have to remind yourself, right? You can maybe trail the market or lose in one quarter or 1 year, but these trends are just so big and so important and so long that you really do just have to start to take a longer view about what's going to happen with this space and the amount of wealth that's going to be created.
Yeah, I mean, Nvidia is the poster child, and we've seen a 50% swing recently. So it it shows you how quickly you move from manias to you would think when something's as certain and as big as AI, you won't have these opportunities, but they will emerge. They will happen. That's the way it always works in markets.
I mean, that's the way it was with mobile. That's the way it was with the internet. And a lot of people didn't understand it. And, they tried to contextualize maybe, how are these older companies going to fit into this new world, not appreciating all the new technologies and new deliveries and new applications that were coming. So we are positioning ourselves right now to take advantage of those, to be informed and to go where the opportunity is going and to invest in those companies that are best positioned.
That's a great point. Let's just think about this as you were talking. The best time to buy Apple wasn't 2007. You would have made more money in 2007. So maybe it was the best time, but it would have taken some risk that a lot of people weren't comfortable with. And it was truly hard to see how world changing the iPhone was. Not many people understood it. But once you got to 2014, 2015, Austin, when you and I were working together and covering Apple on a daily basis and screaming buy, it had reached, I think I was down to, basically single digit PE.
I remember distinctly you and I looking when Apple was at 10 or 11 times earnings.
Yeah.
And just not understanding why you would want to buy anything else at that moment because the trend was so big. It was clearly the front runner, it had incredible margins, and it was just printing cash.
Yeah, no, risk-adjusted basis is what I should say. That was the best time to do it. So, for mobile being as big as it was, and it was kind of, we are now in a world where it's internet, mobile, AI is the next thing. It's pretty clear that's the progression. 7 or 8 years into mobile, you had that once in a lifetime opportunity once again. So, that's why you follow these trends. That's why you listen to, if it's not our show, another show on investing in AI. That's why you keep your, ear to the ground, because you never know. You've never missed it. You've never missed it. There's always opportunities that will emerge if you stay committed to kind of understanding the trend. And hopefully it should be a little fun regardless. Hopefully the worst thing you're doing is learning something about a topic that's changing the world. So I don't know.
Let's talk about things that are changing the world. We've talked about looking ahead. So some of the new dynamics that are out there brewing, we've talked about this new Cold War. This is a geopolitical sort of, X factor that's going to overlay all of this. That doesn't change the scale of the opportunity, but it may sort of force capital into different places at different times or different countries or sectors based on trade dynamics. So definitely an interesting dynamic here. I want to talk to you about that. And then I really want to get to my personal favorite application of AI, which is robotics. I'm incredibly excited for the ideas here and how AI with, there's a lot of fine tuning in actuators that seem like they might need to, really make a leap forward for us to manifest in the physical world in the way that people are finally going to appreciate it. But as you've said, we're looking at where the trend is going, right? It kind of reminds me a lot of solar, right? At one point, you were looking at the cost per gigawatt in solar and saying it was way too expensive. It was never going to get there. But you saw the cost curve, you saw the advancements, and if you looked far enough ahead, you could see a point where solar was actually cheaper than coal. Robotics feels to me to be in a very similar moment right now. We look at these devices, there's heavy batteries, the actuators are not fine-tuned, they're sort of lethargic, But when you start to see the manufacturing advancements that we could make on robotics coupled with the intelligence layer of AI, it's incredibly exciting. So let's talk about these two, the Cold War and the robotics opportunity.
Yeah, and I think the headline is we're going to talk about some topics that are really at the forefront of how we invest headed into the second half. So we had started out this podcast with kind of the data center boom. We've shifted into more software at the beginning of this year. We'll continue discussing that. But we're going to have really new and investable themes that are exciting. So I've brought up this new Cold War a lot in this episode. And partially it's just because I want to talk about, because it's going to be a framing that we'll probably have to lean more and more into as we get to the back half of the year, because it is becoming the dominant issue in kind of geopolitics. I think the Trump administration, it wants separation from China, especially in the area of leading technology. China's always kind of had its own unique ecosystem. Austin, earlier you had mentioned watching things like Alibaba. They have their own unique e-commerce. They have their own unique payment system. Increasingly they're building things in drones, in electric cars. Social media has always been very different within China. But what we're looking at is now the foundational layer of technology, which is the actual building blocks going towards silicon. China's always relied on the United States and other partner countries for, a lot of the essentials here. We're talking about things like semiconductor equipment, the stuff used to make the chips, everything from lithography from companies like ASML up to a lot of the other tools from companies we've talked on the show, like Lam Research. They've made efforts to try and build their homegrown kind of industry here, but they haven't had a lot of progress. Then there's other areas like AI chips, where they've relied on Nvidia in the past. There's areas like memory. And what we're about to see is basically a severance here, where now China is going to have to push forward. They're going to have to use Huawei to build their own AI chips. They're going to have to source their own memory industry. They're going to have to figure out a way to build homegrown lithography. And this is because, again, they are going to be increasingly cut off from the US. And what this creates is essentially increasingly two rival tech stacks. We'll have an American tech stack and we'll have a Chinese tech stack, because there's not going to be a lot of overlap here. And what you could think about is, in the original Cold War, as you know, you could go read Chip War, that, great book on it. We had essential technologies that each kind of block wanted to control, and AI is moving towards that essential technology. Now, what's the opportunity zone right now? And why is this being pushed upon? Well, with Nvidia basically not being able to sell its chips to China, they are backfilling with chips from Huawei. The thing is, China has about enough capacity for its domestic use cases, and it needs to prioritize its domestic. It cannot plausibly go out right now and say, use our memory chips, use our semiconductor equipment, use our AI chips. So that gives an opportunity when we're at the zone where a lot of countries are building out their AI strategy, that if you're the Trump administration, you can use as a negotiating tactic to get them on this American tech stack from the beginning. So what we're seeing is this severance, which for now it's part of negotiating, but in the longer term, it might be setting up which countries are in which sphere for decades to come. Now, this is going to present some threats, and it's going to impact how we're investing. For a lot of areas like semiconductor equipment, I think there's been comfortable duopolies, 3 companies competing. Now you're going to have companies from China pushing as hard as they can on price. But there's also going to be some opportunities. As we noted earlier, Nvidia might be able to backfill a lot of its Chinese demand with areas like the UAE and the Middle East. That's going to become a new dynamic. Beyond that, there's domestic areas where the US doesn't currently have production. You mentioned actuators earlier and things like robotics. There's a lot of aspects of our drone supply chain, of our battery supply chain, of our robotic supply chain that the US doesn't have credible alternatives to China. And we might see some investment areas where to date you could only go and invest in Chinese companies, which most people can't even buy in their brokerages, to a whole new field of investment opportunities. So that's where this issue, it's going to impact the companies in the portfolio. It might impact which companies we sell that are disadvantaged of this, but it's also going to open up some new areas as well. So, Austin, this is one that I think is deeply fascinating. Whether or not you're investing in it, you should be watching and seeing the larger game afoot here, but also it's going to shape kind of that robotics theme, which, I think we could talk about that next, but I won't pause if you've got any, follow-ups or any thoughts here.
Yeah, well, one of the companies and trends that immediately comes to mind, you've been talking about, both privately with me and publicly on the podcast, is lithography and ASML, notably missing from the portfolio. And if you were to just sort of do a generic AI portfolio, to benefit from this trend, ASML would seemingly be in there because of their monopolistic dominant position. And let's just be clear, very deserved, incredibly impressive company. But here they are caught in the middle of this trade war and this brewing Cold War dynamic. And we don't really know what's going to happen. I've seen some reports that China is close to manufacturing their own EUV machines that are on par, if not exceeding ASML. And if the DeepSeek moment showed us anything, it's that you can never count China out of any of these advancements. And wherever we think they are, they may actually be beyond that. But then I've also seen other reports that Intel and ASML are having this really close, cozy moment where Intel is going to try and sort of leapfrog the technology and apply some of ASML's new development techniques. But that all remains to be seen where that lands. How fast China can develop their own alternate technology, whether or not Intel and ASML can maintain this competitive advantage, and other chip makers, of course, as well. But notably missing from the portfolio because we can't currently sort of see through that scenario to understand how that dynamic will play out. So you put your money elsewhere at this time.
Yeah, it pains me. ASML has been a long-time favorite of mine. I've loved this company. I've covered it since the early 2010s on Motley Fool's website. But like you said, the primary reason I haven't had it is because it's in a tricky place geopolitically right now.
They are not in control of their own destiny at the moment. Right? They are stuck between two much larger, much more powerful forces afoot. And there's nothing that ASML could seemingly do in this moment to control their own destiny as much as any administration could.
Go back, and this is an important point. I've discussed in the podcast recently, and this situation has now changed, but I discussed since the breakthrough when Nvidia first announced real serious AI revenues flowing through post-ChatGPT to today, the semiconductor industry was down, and we've got the biggest trend on earth. We've got significant growth happening. The semiconductor industry as a whole had grown 19% last year, which almost no industries grow at that rate. And it's down, and that's why it makes things so hard. But it's also, you need to be aware that just because industries had shown growth forever and semiconductors, it's kind of tracked upwards as just compute becomes more and more essential to the world economy. How can this situation that's been it's got its ups and downs, but on a long-term trend like clockwork, how does that fall apart? And I think the number one way this falls apart is essentially all this competition from China just changes the competitive dynamics. And the number one place to invest in semiconductors from 2010 to, let's call it, mid 2014 was these semiconductor equipment companies, ASML, Lam Research, Applied Materials. The question is, why would that not continue into the future? Well, they have been deeply reliant on China for their business, and that part of them might not only be going to close to zero, but they might now have seeded new competition in that market. So your competitive dynamics could change from a very cozy atmosphere to kind of a brutal kind of price war that could sustain for, a decade or more.
Mm-hmm. And as we have seen with other industries, going back to solar, price wars are China's game to win, so to speak. The amount of subsidization that they're willing to put and the investment they can put in at a nationwide level it makes most price wars unwinnable, frankly. Just with China being willing to go there, willing to make the investments and subsidies that they're able to make in these spaces.
Yeah, and let's just pivot that to the next thing, because I'm sure people are like, "Hey, weren't you going to talk about robotics?" Yes, we
absolutely
will.
Let's move on to robotics. What is the opportunity that you see in this space? I see a lot of humanoid robots, and sort of one of the robotics debates is the humanoid form factor the one that makes the most sense? Our world has kind of been engineered to work for humans, so I can see that case being made. I'm also seeing a lot of other arguments being made that no, we're missing the point. It's not one humanoid robot, it's dozens of purpose-built robots. It's a really interesting conversation going on right now. What are you seeing how AI could affect this space as an investment opportunity? What should we be watching?
By the way, if anyone's watching a video of this, it's funny. As soon as you brought this up, I've got a video over my left shoulder of Jensen Wing with a robot, which is kind of showing what we're talking about. Yeah, it's interesting because you were just making the point of brutal competition. And I brought up earlier, well, the US is behind in some areas like robotics that you might need to put domestically, right? So you've got this need for it. But solar is a great example where solar did work out in all the projections of cost declines, but it doesn't mean that most of the stocks in that were winners because they never got past this kind of brutal price competition. So that's going to be kind of the battle with us in looking at robotics. The key trend right now, there's some stats out that on private marketplaces, there's these companies like SpaceX and OpenAI that people really want to buy, but they're still private. So there's secondary marketplaces to be able to buy them. The number one most in-demand company right now is Figure, which is a company that does humanoid robotics. And what we might be seeing here is with self-driving cars, around 2015, I remember visiting Google, their whatever their research lab was. What was it called? I think it was called like X or something. Which is funny.
That sounds familiar. Yeah, I mean, X is now one of Elon Musk's 12 variations and companies at the moment. That sounds familiar though.
But I remember visiting, and they were so bullish on how they were so close to cracking self-driving cars, and it really just needed to be that we needed to get to the rate of development that Transformers enabled in 2023, 2024 to make this giant leap that we're now seeing with Waymo, where Waymo is going to essentially, by the end of, the next 18 months, is going to have saturated most major US markets. Mm-hmm. So we saw this step change finally happen. The question is, are we seeing the same step change happen in robotics enabled by a lot of physical world training that we're creating and they're able to get a lot better at? I'm pretty bullish on this, but what I want to do is sometime in the next month or two, we're going to do an all robotics episode. We're going to talk about how big the opportunity is, timelines, and the last thing we're going to do is kind of preview some of the stocks and hopefully make some purchases that will add to the $500,000 portfolio. I just will note one thing I really like about this space. When we had talked first about optics, I had said traditionally they were beholden to the telecom industry, which was a really poor industry with cycles and limited upside. And so you had a lot of companies kind of valued like they were these telecom plays with this optionality for huge growth from these AI data centers. You might have something like that with a lot of these robotic stocks, where right now they're valued on something at a trough, like automotive semiconductors is really bad. And all of a sudden, if they get this narrative of robotics, it might allow them to kind of re-rate as a group. So I really like those opportunities where it's high optionality to the upside, but a stock that's kind of at a trough where you're not taking a tremendous amount of downside on the other side. So that's what I like about robotics, and it might surprise people. You're able to get exposure with upside without taking on something that's either 200% gain or a 100% loss. I think the risk profile is going to look a lot differently than people expect.
I love your point about multiple sort of reflecting uncertainty in this sector right now. And one of the easiest things to miss big trends is, to be a naysayer about one factor or another while missing the bigger trend, to be a naysayer about solar or EVs. But robotics strikes me as like the next great space of like technology convergence, right? Like multiple technologies are going to combine to finally make this feasible. And this is not the only time, and it won't be the last time this has happened. If you think about the big tech expansion in the early 2000s, that was the convergence of data and mobile and cloud all coming together and prices being driven down and technology, making that experience more powerful. And EVs, right? We needed to see battery technology as well, sort of advanced to a point in manufacturing, advanced to a point that we now, Model Y was one of the best selling vehicles on earth, I think in 2023 or 2024. And robotics feels the same way to me. We've got manufacturing advancements, obviously AI, but then you also have 5G, right, which enables it. And like robotics can be significantly more valuable when you have that high bandwidth data layer as well, and connectivity components. So this seems to me to be one of the next great sort of convergence sectors, where when those technologies all converge and the price point starts to make sense, you get this explosion of utility and value. But because you need multiple things working at the same point in time, it's very easy to doubt that it happens. And they see lower multiples as a result because there's too much uncertainty for people who don't see that convergence happening.
Yeah, I don't think most of these stocks are priced out outrageous levels. So it's good. It's going to be exciting. Like you said, we're entering a virtuous cycle where the AI technology gets good enough to really thrust some investment towards a lot of these, categories that haven't had investment in the past, and it just kind of supercharges it. So I'm excited for this. I can't wait to dig in deeper.
Well, Eric, I think that's a full episode for today. We've taken quite a lot of our listeners' time. I just wanted to look ahead to our next episode and agentic AI, right? We wanted to talk a little bit about this and sort of throw the ball forward to what we'll be discussing on the next episode here.
Yeah, we were previewing robotics and we're previewing the Cold War, and I think that was a good amount, but those are some things we're going to be taking deeper dives into in the second half of the year. And I think if you're looking for where we're continuing to look for some new investing ideas, I think we want to catch up. What has the growth been in agentic AI? And also, are there other companies? We talked about those software ideas like Snowflake and Cloudflare, but what's the next category of stocks that we might put some on the watch list? We might even make an addition next week, but I think I would like to dive into that. Finally, I'd just like to say, I know we've been gone for a little while, but if you are listening to the show and you have enjoyed it and you've never given a rating, we just really appreciate that. We kind of stop badgering people and we haven't seen any, but that's what helps get us into algorithms, helps us get discovered by new people. Again, we're not charging anything for the ideas that we talk about on this. So if you could do that, it just helps us get kind of the momentum, and we would like to continue putting the time investment into doing this show every week. If you find it valuable, just that little action would go a long way in helping us keep the show going. So we would appreciate that.
Eric, thank you for that note. We do value our listeners. We value their feedback as well. We value their follow. So please engage with the podcast, engage with us on YouTube or wherever you listen to your podcast. Send us questions if you have any. Eric, thank you for your time today. Listeners, thank you for tuning in. We'll see you on the next episode.